Hello friends. So today actually I wanted to talk about actual P&L and hypothetical P&L and what is their use in the FRTB model backtesting. So if you have read through FRTB program, then this actual P&L and hypothetical P&L comes, and how we can use them in the value at risk backtesting and in the model validation, and how they are constructed. Okay, so let's deep dive in. So yeah, so actually, so there are two different P&L measures. Okay, let's deep dive in. So suppose we have created the model, expected shortfall model, okay, for the FRTB, and but it can create the capital requirement. Okay, so that's the plan, but but the model needs validation. Okay, is your model correct, which predicts the capital requirement for the bank? Okay, so value at risk backtesting, it is that model validation, part of that model validation, and in that part of model validation we need to compare the PNL generated in the bank versus the value at risk predicted daily by the bank model, by the expected shortfall model. But the point is that we don't use expected shortfall here. Okay, we use value at risk model. So a value at risk at the 97.5 and 99 percentile. Okay, we pick that var and compare it to PNL, and that PNL is APL and HPL. Okay, both. It is, this back testing is done to both for 12 months, past prior 12 months. So that's the point. And both HPL and APL are created from the same PNL book. Okay, but there are slight differences between them, and that I wanted to talk about today. And let's see how we create them. Okay, what is hypothetical PNL? It looks cryptic, and it's more like let's see what it is. Okay, it's more like this PNL does not include any intraday positions. It does not include commissions, fee and commissions, intraday positions. It is only PNL on your previous day. The previous day positions are frozen. Okay, suppose today is 8th of August, right? And so this PNL is calculated purely on 7th of August positions. Okay, if on the 7th August I have like 10 bonds and 20 stocks and one swap, then it is calculated on these positions only. Okay, nothing more, nothing else, simple as that. And so that's the one thing. Okay, what is hypothetical PNL? Okay, positions are frozen. Okay, I hope that makes sense. And so the positions remain same between t minus 7 and t. Okay, then what does change? The risk changes in the portfolio, right? If earlier the PVO one was like 20,000 in my portfolio, now today is like 30,000 PNL. So yes, so that thing changes, and we multiply that our position size or sensitivity into risk change. Okay, so that is so that thing changes. So I will explain every example. Okay, so but from this picture it should be clear that okay, we are calculating PNL on t minus 1, simple as that. Freezing the book. Okay, so that's the point. We freeze the book. Okay, intraday positions are not included in HPL. Okay, and and commodities and foreign exchange positions are added. So it is explicitly written in the MAR 32 that FX positions and commodities are held. Okay, even if they are in the banking book. Okay, it's not. So this is exception. Even if they are in the banking book, then they should be included in the PNL. And this is the same in the full FRTB framework. Okay, HPL calculation is nothing different, or even APL. Uh, yeah, so it is simple thing. Okay, market movement. This PNL is generated simply from market movement. Okay, if your stock prices change, okay, or the interest rate changes, then yeah. So stock prices change, interest rate change, then yes, that is driving your PNL. Nothing else. Position stays same. Yeah, so that's the main point. Okay, so that's your high. It is simple actually. And what is APL? So APL actually, for the daily PNL the bank reported. Okay, the daily PNL that the bank reported, APL is generated from that. That's why it is called actual PNL. And So it is uses the same model parameterization, same modeling technique and everything else, but it excludes many things, okay, like fees and commissions. Okay, it was not in HPL, it is not here. And it there are some valuation adjustments which are added, okay, which we'll talk later. So then, okay, if you think like market movement remains, intraday trading, okay, so that's the most important difference between HPL and APL. Intraday trading, okay, suppose I entered into a like exotic position today, like intraday I bought some options in 11 a.m. In the morning, okay, after they started, and then I closed that position intraday at like 3 p.m. Okay, for 4 hours I held that position. So that PNL generated from that position will be added into the APL. So this is the most important, okay. It's about what was happening in the day, and less about, okay, what was at t minus 1. Think like this. Your HPL measure actually talks about t minus 1. It is about model validation. If you strictly think about what you studied in FRTB, in the expected shortfall model, it was all about, okay, positions were frozen t minus 1. Okay, what was the risk in that position, how those positions drove the PNL, how the market movements drove the PNL. So that is your HPL, okay. But then when you think about intraday trading, right? uh, so why was APL introduced? I will also tell you, but was introduced because if the bank does a lot of intraday trading, okay, it generates PNL. So, but that PNL won't come in your HPL PNL, okay. The model validation cannot actually detect that. So that for that you needed a different kind of measure, and then came the APL, okay. So to figure out the impact of intraday activity, okay, and does that break your model or not? Does that break your back testing or not? So that's why APL came, okay. But yeah, yeah. So okay, so that's all. So this is the difference between hypothetical PNL and actual PNL. And yeah, you see, you think that there is few differences, right? One is the intraday training, that's the biggest, okay, and one is the new and modified deals, okay. In Suppose you make some change in the deal, okay, in the today, then it comes here. And then with some valuation adjustments, like so that we will talk about later, okay. So there are three main drivers, and the major driver is your intraday deals and new and modified deals, okay. Like intraday, when you think actual, think intraday. And fees and commission, they never appear here, okay. They never, it is accounting thing. So when you think about HPL and APL, fees and broker commissions, broker fee, it does not come up here, okay. So that is, does not come up as loss. uh, so this is the gap between APL and HPL, my friend, okay. So your HPL and APL both track end of previous day market moves, okay. Market moves on end of previous day positions. What is the change in stock prices, rates, FX rates, commodities, everything, okay. But then the difference comes in the intraday, okay. The second most important point, the intraday, that's my friend. And I think I showed you maybe okay. So see, so we are talking about this stuff here, okay. So that is the guiding star, my friend, okay. Yeah. And fees and commissions, yes, it does not come up in anyone, okay. New and modified deals, okay, it is just like intraday trading only, okay. Like changes in the deal, it comes in the APL PNL arising from that. And CVA, okay, CVA has its own regulation, my friend, okay. CVA has its own regulation, counterparty credit risk, it goes there, okay. Neither HPL, neither APL. And valuation adjustments, they don't go in them, okay, because even if you actually add your DVA into accounting income, okay, even if you do that, but then Basel, if you have gone through cap 40 or 32, it will come later. Then you remove that DVA charge from common equity tier 1. So that capital is already removed. So it's DVA, in nutshell, DVA does not come up in any of them, okay. DVA does not come. And the other valuation adjustments, okay, they can come in APL, like yeah. Yeah, and the theta carry, suppose there is some carry for some investment. You have some gold commodity in a locker somewhere, right? Or some bond, which bond is generating some income, right? So that income goes there, and if goes in APL, uh, okay, passage of time, and then if it goes into APL, then you need to add it into APL and sorry, HPL and RTPL. I will cover RTPL in another session, okay, not today. Yes, so your theta carry and any income or loss for just carrying the position, which is called carry, okay, it is included in APL and by consequence in HPL as well. And FX positions and banking book commodities, yes, they are part of both, okay, we cannot leave it out. You might think, okay, these are banking positions, right? It does not work that way. And yes, so that's all, okay. And some valuation adjustments which are done at the bank level, so they are still added in both, okay. Yes. So and there is one more thing actually. If there is some valuation adjustment like a bid offer reserve, okay. Some companies keep bid offer reserve, which I will tell in a later example. But if it is calculated monthly, then it goes into APL only, not in HPL. Okay, it's a timing game. If it gets calculated daily, then it also smoothed out, and it gets incorporated in HPL. This valuation adjustment, but if it is monthly, any of these VAs, okay, then they don't go into HPL. So was the last point. Uh, so fees and commissions not in any of them, okay. It's a good thing. And then what is being tested? So now the next point, okay, what is being tested? Okay, what do we test with HPL? Okay, so suppose you have a book B, okay, which could be like credit desk book or rates book, okay, and you so risk system take a snapshot on T minus one, right? You know, okay, these are my holdings on T minus one. Okay, then the value at risk is calculated based on this 250 days, and remember T minus one position is part of that snapshot. Okay, it is in the model, and you see the PNL is also getting calculated on that positions. So there is some commonality between the PNL calculated input and VAR input. Some common, that single position or T minus ones. Okay, and then on T the market moves. Okay, rates move, prices move, and then you calculate PNL from difference between those 2 days risk factor changes, and then HPL revalues the snapshot at today's prices. And then yes, this is the HPL that we discussed, right? Simply on the movement, okay, nothing about positions, nothing about position changes. Then APL is different, okay, it also includes what was traded, right? It also, okay, if you remember this diagram, okay, the second bar, intraday trading, okay. Yeah, so that's the difference. Yeah, so HPL says what happened to your book, okay. H So, and APL is about, okay, what book you actually ran, okay. Suppose if a bank opens a position intraday and closes it before end of the day, then nobody would know that okay, such a position existed, okay, if they don't add its PNL into the books. But they have to add the PNL, so that's why it is that. Yeah. So what happens intraday? Think like this: can your model stand the intraday running? Is your the model that you are using for capital calculation, is it ready for intraday working? Okay, because a lot of intraday trading does happen in these broker dealers. So HPL tests the model. Think you can easily test the model through it. It is the real model back test. It is so whatever PNL actually comes out of it is market movement, right? Nothing else. It is pure market movement, and you should be able to capture the market movement. Okay, your value at risk should be adequately capturing that market movement, adequately capturing the correlations, volatility, right? Movements. It is a very clean test, but it uses frozen book, and it believes that, okay, bank won't trade something intraday. So it's too clean in that sense, okay, it should not be so clean. So that's why APL came, okay. Yeah. So it is one line, okay? Does the risk model capture the market risk? Okay, simple as that. It's about market risk, your HPL. So that's what you do when you do its back testing with HPL. So if a exception happens in the HPL, okay, then what is the root causes? That's the point. So what I told you, that it is your risk assumptions, distribution assumption, correlations, volatility, right? If they are too less, okay, volatility and correlation, or even the tail weight or tail length, then the value at risk is less, right? If you're thinking that your well distribution is like narrow, then your value at risk will be less. And your actual distribution has fat tails. If you remember, if you model the this value at risk model using T distribution, then it can actually the value at risk will be more, and there would be exceptions across the books, across the desks, across the days. Okay. Yeah, so that was the first point. Okay, then there is some problem in your broader risk model. Okay, you are not able to capture risk. Okay, model assumes markets are less risky. And there is the second, the pricing is wrong itself. Okay, pricing means you have very what do you say, option. Okay, you have one option with very high convexity. Okay, non-linear instruments, derivatives, and you are using just delta to price the instrument. Okay, you are not using convexity or gamma to actually make the better PNL estimate. You should use the better PNL estimate, handle the convexity, handle the all the approximations matter, second order, third order approximations using the Taylor series. So that's the point. If you cannot price the exotics, then okay, the second type of error will come in the HPL. Yeah, so this is the second exception, right? Okay, sure. Next point. So this is explained diagrammatically. The first point is right. You have a bell distribution curve, and my model assumes the risk is less volatility, less correlation, right? Thinner tails. That is the blue one, actually, the first blue bell. This red bell is okay, what the actual market is. So then the risk will be more, and there will be exceptions, more exceptions actually. And the second one is when you use delta, you might have used the delta gamma approximation, right? So delta, it does not give you a good approximation if there is non-linear relationship, is there is a lot. Okay, if it is curvy, then you need to use gamma and convexity. You see, there would be a lot of difference if the movement is higher. Okay. So yes, so these are model problems, simple. HPL test simple model. Okay, now the APL comes. APL is somewhat different. Okay, what happens intraday? Uh, okay, so what can happen inside a day? Okay, uh, so so a bank can start in a day, and actually it can create risky positions in a day. Suppose the bank started trading very risky exotics. Okay, and then it closes the risky exotic positions before the end of the day, then the HPL won't detect it. Okay, that's why APL is there. And remember, whatever if you can compare the HPL to the daily value at risk, okay, then suppose in the HPL you don't see exception. Okay, HPL is less than VAR. Okay, no exceptions. But APL actually breached for the same VAR, then it is counted as exception. Okay, whichever breaches APL or HPL, it will be counted as exception in fact testing. So that must be remembered. Yeah, so HPL won't show intraday, right? It's about catching intraday movement, and whether your model is receptive to those intraday movements. So okay, so this is example of what I was talking about. So suppose I have these positions like 10-year swap, 5-year swap, 2-year swap, and these are the positions like 67,000 PVO1. Okay, when you add positions intraday, suppose for example here's the trader opened one position at 11. Okay, the second diagram, at 11 he opened position, and yeah, sorry, wait for 1 second. Yeah, and it closed at like 4 p.m. Okay, 4 p.m. it closed. So yeah, so this position won't be shown in the your HPL. Okay, so you see your HPL PNL is less. Okay, this example assumes that there was no loss on the same positions. Okay, sorry, loss less than var. Okay, but this risky positions created actually loss, and APL, that's why it breached the value at risk. APL was more than value at risk. So yeah, so that's the point of APL to catch some intraday losses. That's the point. Okay, and so what is added in the PNL for HPL and APL? Okay, that's the point. Okay, if you went through my previous session, then I so what happens that there are two types of factors. Okay, modelable and non-modelable factors. So modelable factors for which you have prices. Okay. Which you can model using prices, you can calibrate your model on them. Okay, so yeah, so those factors go into expected shortfalls. Okay, expected shortfall model, then you calculate your value expected shortfall based on the capital. Okay, so it works like that. But there are some risk factors like very exotic, like 15-year swap or 20-year swaption, something like that. Okay, which does not get traded, or very like trades in the wings of options. Okay, wing options in which the delta is very high or very low. So yeah, they are non-modelable. There are not plenty of prices available for them. They are non-modelable. They get their capital gets calculated through stressed expected shortfall. Okay, SES. Okay, this is the second diagram there. And yeah, so it is modelable out, non-modelable it. Okay, it gets calculated that way. So yes, we calculate capital for both modelable versus not, but in the trading desk risk management model we keep both. Okay, all factors are there, full positions. Remember that if you have very exotic positions which fails the RFET, risk factor eligibility test, which I discussed in my last session. Okay, so then even then it gets added to the trading desk risk management model. That's the point. Okay, leave nothing out. Yeah, okay, leave nothing out. So the point is, okay, if you can if you don't have enough prices for a factor and it gets priced using stressed expected shortfall, then how can you add it? Okay, that's the point, right? The point is there are always proxies available. Okay, proxy may not be like absolute representative. Okay, and or you can proxy through some index, multiple indexes, or regression. Okay, some some representation should could be possible. Okay, so you cannot leave nothing out. Yeah. So this is session 3, my friend. So I wanted to tell you what valuation adjustments, okay, do we add it in APL and not. Okay, so let's see. Okay, what are these valuation adjustments? uh, so there are basically only two questions. Okay, does it have its own regulatory regime like CVA? It has its own, right? So we don't need to add this to this PNL, or is it or this has already been deducted from CET, then DV. Okay, it's not there, so it does not get added into APL and HPL, right? And is it market risk related valuation adjustment? Okay, then yes, obviously this is market risk framework, add it to APL. Okay, and is it updated daily? Then actually yes, it goes into both HPL and APL. Okay, that's the point. If it does not get updated daily, then not in HPL, my friend. Okay, sure, that's all. So this is the framework of questions. Okay, someday if you ask, okay, this valuation adjustment, some sort of buffer. Okay, do I need to add it to APL and HPL? So this is the questionnaire that you need to ask. And there are many buffers, concentration risk measures. Okay, which track the concentration of issuers, and bid ask actually, which I will discuss. And this is yeah, Yeah, okay. So yeah, it's the same thing actually. This what that was the first question. If the valuation, if the for the this that risk, okay, if the CVA this valuation adjustment, if it has its own regulatory department, its own regulatory group, so it does not get it added into APL or HPL, and same for DVA. Okay, it gets deducted from CET. So if it gets counted somewhere, okay, then we don't need to double count. No need to double count it. Okay. Yeah. Sorry. Wait for a second. Yeah. So no need to double count and all right. So yes. So now we know what should be added into HPL and APL. Okay. And yes, and this slide talks about why we cannot add DVA charges into PNL. Okay, because it is already removed from CET. Okay, no need to actually add into HPL and APL. So DVA is nothing but debit valuation adjustment means if I am a counterparty to some other bank, okay, like Goldman Sachs, and my credit quality deteriorates, then I can actually book a gain in common equity. If my credit rating decreases from like double A to A, then I can book some profit, sorry, gain in common equity, and so that's the point. So that is DVA. So it should be removed. It does not go there. And now what is the question for? And is it calculated daily or monthly? So that's another question. If it is calculated daily, then yes, go into both APL and HPL. Okay, like bid offer. Okay, on any liquid rate or FX book. If monthly, then it goes into APL only. Okay, like model uncertainty or concentration reserves. Yeah, sure. And yes, yes, if sometimes yeah, suppose what happened, yeah, so this is a monthly reserve, right? And it lands in the HPL, sorry, APL alone. And if it lands in APL alone, then it will diverge from HPL. If you remember that it is landing in APL alone, then it will diverge, and there are chances of breach then. Okay. So okay, so then we should document reason of every exception. Okay, so if APL diverts from HPL, then it is possible that it will increase, it will be more than the value at risk for the calculated by model. Then we need to tell the regulator that yes, that's the reasoning. Okay, so we have to track reason for every exception. That's the point. uh, yeah. Yes, so for the bid offer, there are two things, okay, which are driving the market. Uh, yeah, sorry. Yeah. So, so I think I need to go through this example, okay. So suppose you on the T minus one, you have 80,000, okay, position, and bid offer reserve, okay, 80,000 bid offer reserve, and then the 20 basis is the mid, yeah. So yeah, so actually, yeah, let's connect after some time. Yeah, thank you.